Good afternoon, and welcome to the Texas Public Employees Association Lunch and Learn series. We're continuing today. We're talking about financial wellness for women. My name is John Green with Association Member Benefits Advisors. I'm joined by my co-host, Deanna Bockham, who is one of our leaders in the Austin and West Texas, South Texas area. She's got a lot of area to cover there, as well as Legislative Liaison Ray Amell. And Executive Director Ann Bishop has joined us as well. So we've got the full crew here today. We're going to talk about a lot of things. While this webinar is more geared towards women and some of the financial issues that they face specifically, this is great for anybody and just help you understand what could be out there for your spouse, for your mother, or for your daughters as well. So grab a pen and paper today. A couple of quick housekeeping details. All participants are in a listen-only mode. And that means if you've got a question, you want to drop it into chat or in a Q&A, Deanna and Ray and I can monitor that chat and answer back individually to you, or we can get back to the group if it's something that would address the whole group as well. We do record these sessions. We put them out on the TPEA website under the members section that you can refer to them in a future date as well. And then you also notice down in the bottom right-hand corner a QR code. We're going to have that throughout the conversation. But if there's something specifically that you want to ask about in terms of a concept we've addressed or a plan or something like that, you can simply take your smartphone, hover over that QR code with your camera feature, and a little form will pop up. You can ask that as well. So it is the summer. It is triple digit weather now is coming up, but that doesn't mean that things have slowed down. So just a quick reminder about TPA before I ask Ray and Ann to come in and share a little bit about what's going on in the summer. Just a reminder, over 75 years ago, the Texas Public Employees Association was formed, and that was kind of where employee benefits started to come from for state employees, as well as they were the forerunners to helping you get access to pensions. And long before ERS was even set up, TPEA has been there for you. They're out there on the front lines fighting for your pension. And I'll let Ray share about what they're doing as far as testimonies right now, but also to protect those benefits that you've earned, whether you're retired, whether you're still an active employee, working for funding levels, and then to provide you with education, discounts, benefits, a lot of other things that you may not be able to get anywhere that you can only get through TPEA. So Ray, I know the summer is slow for some folks, but it's not for TPEA. So kind of tell us what y'all are up to these days.
Thank you, John. I guess the number one thing is that we are trying to continue our contacts with various legislators and their staffs subsequent to some committee hearings we testified at and submitted testimony to, which you can access on the TPEA website, tpea.org at advocacy. Click on advocacy. We first of all testified before Senate Finance Committee regarding the effects of inflation on the budgets of both employees and retirees. In fact, there's a new report out just the last day or so that inflation has now exceeded 8.5% annually on an annualized basis. So, and we also were pleased that and appreciative that the president of the statewide retirees chapter, Dan Maxwell, testified about just the effects on groceries and gas bills alone for a retiree like himself and a lot of other retirees. But we know that folks are beginning to feel the strain from gas prices, and you go to the grocery, you either buy generic or you're going to walk away with a bill that's $50 or more higher than you're accustomed to. So we testified about those effects and about why that compels, we hope, the legislature to look at meaningful pay raises and also an increase for retirees. And those are two separate issues, obviously, but they're both equally folks that really need help. And then we have followed up with some legislative staff and legislators as far as, re-emphasizing those points with them in private visits, which we continue to try to arrange between people's vacations over the summer. In the meantime, there will be on the ERS front, you'll be pleased to know that ERS has kept your insurance program very much intact, very robust and intact. No increase in co-payments and co-insurance. premiums either. So you have a really good benefit there in your health insurance through ERS. And over the course of the summer, some of you will have at your agencies opportunities to attend summer enrollment fairs, and sponsored by your agency and ERS. And look for information about those. And there will also be some webinars being offered by ERS, and you can find that information on your website, on the ERS website. But in addition, TPEA will try to be at some of those summer enrollment fairs, and hopefully you will come by and visit our table, and we can visit about any issues of concern to you. But I don't want to sign off without saying with great emphasis how much what you have done is commendable, and appreciate you for all that you've done through the freeze and the fires and of course COVID, and the floods. And so we just want to make sure you know how much you are appreciated, you state employees and you who retired from state employment. So please pay attention to our website, and above all, if you're not a member of TPEA, please consider joining, because we are going to make there is strength in numbers, and we really need to make a push this time, for both on the pay raise front and on the pension increase front. So on that note, Ann, did you want to add anything to augment that?
The only thing I wanted to add is that we are tracking and monitoring the Senate interim charge on remote work, and have testified on the ability or the need for agencies to keep their flexibility in remote work, and be able to set their own standards and their own policies for that. So we'll keep you updated to see if there's any legislation introduced on that issue as well. And I saw that there was a question on how long before, if we do a pay raise. Of course, this has to go through the legislative process. The legislature does do the budget, and the agencies request their budgets. Most of the budgets requests are due in September. There's a few that are due after September 1st, and then the legislature would begin the deliberation when they come in town in January. So it would not be this September for a statewide pay raise. It would be next September. However, agencies do have the ability, if they have the money in their budget, to give pay raises throughout the year. And we can't answer for each individual state agencies, but as far as the legislative session and across the board or inflation adjusted pay raise, it would be effective potentially next September.
John has put something up there about the TPEA annual meeting that's coming up June 25th, 9 a.m. at the ERS building. You see that address there, where it's going to be at the ERS building. And we hope that those of you who are members or who might consider being members will join us. You'll have an opportunity to attend in person, but we also will be making that available via Zoom. So,
and you can register either way, in person or Zoom, via tpea.org. Go down, or at the top of the header, you'll see an events link there. Drop down on that events link, and you'll be able to register and go about the conversation that way. So let's go ahead, before we move forward, just make sure we've got a few questions that have popped in here, and I'll let Ray and Ann answer those. And some of those are individual questions as we roll through here. Just a quick reminder, Ray mentioned this, membership is so crucial, especially this time of year, as we're building towards these legislative hearings, as the ERS benefits meetings are taking place. This is an excellent time for you to tell your coworkers, or if you're not a member of TPEA, to join TPEA, because whenever it does come time for certain hearings related to COLAs, pay increases, remote work, we need to have a volume of members behind that. 650 members became new to TPEA last year. You can join. You can recommend somebody to join. If you're an active employee, it's $750 a month. for retirees or for those who are associate members, maybe that just don't, didn't retire, or they maybe work for just a little bit for the state, or you want to support what TPEA's efforts are. It's only $250 a month as well. And you can do that on the website. We can take care of that for you that way. But strength in numbers makes a difference, especially going into election season this fall, being able to support those candidates to support state employees as well. We've had some people ask a little bit about who AMBA is, who Association Member Benefits Advisors is. We work with, partner up with TPEA and similar public servant associations all across the country to help provide them with marketing assistance, membership drives, as well as benefits, things that maybe you lost whenever you left state employment, or maybe your children aged out of those benefits, things of that nature. So that's what we do. We're based in Austin. We've been around for over 40 years, and we're proud to associate and affiliate with some of the finest public servant associations across our great state and across the country as well. We help, as I mentioned, provide supplemental insurance benefits, lots of fun stuff like travel discounts and shopping. So many things in Austin are new on there as well. And then we also involve some other plans and things like that that maybe you could use for yourself or for your family. And some of those advantages, as I mentioned, of having AMBA and TPEA together are to fill those gaps that aren't covered by your state benefits. Maybe it's things that you left behind whenever you retired, or maybe it's something that you don't have access to now as an active state employee. And these benefits are portable, meaning if you leave state employment for a while, go into the private sector, go to a county, come back, that type of thing, you don't have to worry about these benefits leaving you. You can take them with you. But the biggest thing that a lot of TPEA members really appreciate, whether they're retired or whether they're active employees, is the ability to extend their benefits from TPEA to their adult children who may be aged out of their state benefits, or if you're responsible for your parents, their care, you can be able to extend the benefits to your parents as well and help them to take advantage of it. And you don't have to then take off work if you have to care for your parent, something of that nature. So we're going to talk today a little bit about financially successful strategies for women. And we're talking about this. I'm going to show you some of the numbers here in a moment, why it's so important, especially in today's workforce and today's environment, and give you 4 key areas to focus on with some practical steps that you can take now. Some of these are going to be steps that I'm going to tell you, go to a website, do this, do some research, and kind of get you started on your journey. This is really a high-level overview. So grab a pen and paper. We're going to walk through this conversation today. And whether you're joining us as a female, we appreciate that. A male, doesn't matter. These things impact you across the board. And the reason we're having this conversation today is because right now, nearly half of all women are the family's primary breadwinner. And at current, women control over 60% of the wealth in the United States. And that's because of working environment, because of inheritances, things of that nature. We have this conversation so that you understand what the impact is and why you need to prepare properly and have good strategies out there that way. And 95% of all women are solely or jointly responsible for financial household decisions. So knowing what could be a challenge out there, knowing how to address it head on, are important reasons as to why we're having this conversation today. And as women, you face unique challenges. You have a much greater life expectancy than men. And therefore, you've got to prepare for many more years in retirement. So the impact of inflation, the impact of health issues as you age are greater than men. And so you've got to prepare for longer situations out there. And so in addition to that, there are many times women take time out of the workforce to raise children, have children, take care of an elderly parent, something like that. And that impacts pay. That impacts the ability to save in a pension, to qualify for a pension for longer, things of that nature. So you kind of have this double whammy of time out of the workforce for family issues, also a greater life expectancy and needing to prepare for longer living and the impacts of inflation out there. So these are reasons why we're having this conversation, to get things on your radar to help you prepare for the future that way. And so consider these numbers. As I mentioned, women at some point in their life are going to be responsible, 90% of them, for their family's finances solely in their life. Now, whether this could be a spouse passing away, a divorce, job loss, whatever it is, That's a lot of weight. And so you've got to be prepared for that. And we talked about life expectancy. On average, women will outlive their husbands by 15 years. And being prepared for the loss of spouse and maybe the loss of some of their benefits, their retirement benefits, pension, something like that, can greatly impact women as well. And as I mentioned, because of inheritances, the baby boomer generation has so much wealth, they're going to be passing that down over the next 40 years. You're going to get the bulk of that. Women are going to be responsible for receiving the bulk of that. What do you do with that money? How do you protect yourself, protect your family, and properly use that money? So let's jump in and talk about kind of the 4 key areas that you want to focus on. And these 4 key areas are in relationship to your budget, in relationship to insurance, in relationship to final expense planning or life insurance or life expectancy, and then how to protect your nest egg. So we're going to jump through and just kind of highlight a few areas in each one of them, show you some government programs or some tax programs that can help you maybe save some money differently, help you pay off some things, but ways that you as successful women can navigate the whole financial world and prepare for, your future as well. One of these is in budgeting and the use of credit. When you're looking at a budget, determining your net income, recording all your expenses, pretty basic stuff. There's a lot of different programs that are out there. Some people use the Dave Ramsey method. Other people will use certain methods that are online, things like that. Make sure that you include retirement and emergency savings as part of that. Now, I know inflation and sometimes lack of pay increases can really make that tight. I'm going to show you just some of the things that if you just did a 1%, what that could make a difference for you in a moment. But creating that budget and sticking to it can help you in the long run and give you much greater flexibility. One of the things that we find with women oftentimes is that they tend to have challenges with their credit that will have them either pay more as a result of a credit score or have a challenge getting credit to open up the world of home financing, apartments, and things like that. Our credit score determines a lot of factors. It determines how much we pay for car insurance and home insurance. It can determine, of course, the interest rate which we receive on our mortgage. It can also determine the deposit or the rate that you pay on a rental property as well. You have, through the federal government, a free credit report every year. This does not impact your credit when you run this, but I encourage you to go out to annualcreditreport.com, run your credit score every year. You want to do it for 2 reasons. One, you want to make sure that you're on top of it, you know what you have, and if you need to do something differently to improve your credit score, to drive down an interest rate or to drive down any type of rent charge or deposit, something like that. The other thing is you want to make sure that somebody has not messed with your identity, that there's not something else out there that somebody's using your credit, doing something that can damage that for future use there. So go out to annualcreditreport.com. Make sure that you see that it is truly annualcreditreport.com. Don't just type in a search bar, free credit report, because there are a lot of imposters that are out there. Go to annualcreditreport.com and they will make sure that you get the proper annual free report on your credit score. We encourage you to do that as well.
John, does it matter if it's initial capital, or small cap or what on the annual credit report?
It does not. No, you just
Okay,
go out to annual credit, lowercase, uppercase, doesn't matter. It's going to get you there, but it's all one word, annualcreditreport.com, and it will get that site out there. So it's graduation season, and many of you may have had a student graduate from high school, getting ready to go into college, student graduate from college, or some of you may have student loan debt yourself. And women carry a significant burden, especially when they go into public service, because oftentimes that cost of college is not as quickly paid off because, as you know, in public service, you may not earn as much as in the private sector. For public servants, and this is for state employees, this is for educators as well, there is a public service loan forgiveness program that allows you to get your loan forgiven under certain requirements. Once you make, and back up, it has to be, you have to be a full-time employee, 30 plus hours. It is for direct and direct plus or parent loans. So if you are a state employee who's taking out loans for your son or daughter, you could possibly get them forgiven as well, even if your son or daughter are not in public service. So it's got to be either direct loan or a direct plus or parent plus loan. Once you make 120 equal payments under this program, your balance is forgiven. And on average, it's about $68,000 of student loan that's forgiven. You can start your journey and looking into this at studentaid.gov. There's also another neat feature that's out there, and this really applies to a lot of state employees that are frontline employees making, less than $50,000 a year, something like that. Depending upon your income, your family may qualify for an income-driven repayment program. What that means is say based on your family income, it says you can pay $100 a month toward your student loan. Here's the cool thing. You make 120 equal payments, even at that lower income-driven repayment program, then your loan is forgiven. So it's even more money is forgiven. Again, this is reserved for state employees, even public servants like nurses in county hospitals, state hospitals, things like that. You may not be directly employed by the state, but if you are in a public servant role, I would encourage you, if you've got student loans for yourself or for a child, go out to studentaid.gov and take a look at that and start that process out there. And Bridget, you brought up a great point. It does have to be a qualifying payment program. I've had people ask me in the past, well, what if I pay $50 one month and then skip a 3 or 4 months and pay $200, that kind of thing? How does COVID affect this? All of that is spelled out there on studentaid.gov, but it does have to be a consistent 120 equal payments. It can't be in forbearance. So, there are some requirements. I'm not saying it's an easy program, but again, from a financial standpoint, if you're responsible for your own loans or for a student or for a son or daughter's loans, I'd highly encourage you to look into it. It's one of the perks of being a state employee and a public servant. And as Ray mentioned, we thank you for all the service you've done throughout COVID, freezes, fires, floods, the whole 9 yards. This is just another way the federal government has set up to help you pay off your loans quicker and get loans forgiven by being a state employee. So go out to studentaid.gov and take a look at that, because it is, as all government programs, a fairly tedious process that you have to go through to get it done, but it can save you quite a bit of money. All right, let's flip on the other side of budgeting. When it comes to insurance, and especially in your home and auto, we've talked about how credit can impact your rate that you pay, depending upon your credit score. I want to give you some realistic tips right now for home and auto that you can save some money right off the bat, especially for those of you who live near the coast as we go into hurricane season. Let's talk about that. On the auto insurance side, always check your deductibles. You may have a large deductible that you can't afford, but you've got it because you're trying to pay less on a monthly basis. Or if you can afford to maybe go up to $1,000 deductible and save some money that way, you can save it that way. Ray and Ann mentioned about telecommuting or work from home options. Most auto insurance is based on the mileage that you drive. If you're now working at home, I would encourage you to call your insurance agent and say, hey, I'm no longer commuting into the office. I'm no longer driving X number of miles per month, per year. Please re-rate my vehicle. You may have an option where you can take one of those telematic programs where you can plug it in or use your smartphone app and they can rate you on your mileage usage. You can, or they can say, all right, based on what your car is, you now are 5,000 miles a year, something like that. I highly encourage you to call your agent and ask about mileage rating, because it can significantly reduce your insurance rate, especially if you're working from home. And always shop around. I encourage you at least every 2 years to shop around. Many insurance companies will offer discounts for new customers, especially if you've had certain levels of coverage in the past. They'll offer discounts. And so it'll seem very tempting to move over to another company for a 25% discount. But be very, very careful. You may be losing some benefits that you've earned on the backside. To give you an example, you may be losing some claim-free discounts, some discounts that if you do have a claim, they'll waive your deductible, things like that, or some renewal discounts. So be careful when you do that, but highly encourage you to shop around and look for an agency that maybe they can comparison shop for you. So there's some ways that you can save on auto. On home, it's very similar, but it's different because of this astronomical home pricing bubble right now. Always check your deductibles, meaning the amount of money you're going to have to pay out of your pocket. If you're living in Central and North Texas and a hailstorm rolls through, really you want to check your deductibles to make sure that you don't have a separate hail deductible that you would have to pay 2 or 3% of your home value before you got replacement on your roof. You also want to check and see there are certain companies that once your roof reaches a certain age, they will only pay you a portion of the value of the roof. They won't replace it. So you need to watch out. Like I said, you may think you're saving money, but in the long run, if a hailstorm comes through and they only give you half of what your roof is worth, because that's the way the policy was built, you really don't save a lot of money that way. For those of you that live along the coast or who live in Houston, or maybe that second tier of counties, Harris County, all the way down the coast, second tier in of counties, many companies are putting in a named storm deductible. And what that means is that there's a tropical storm out there that it becomes named, then you will have a 2 or 3% or sometimes 5% deductible if you receive damage from that storm. It looks great while you're receiving what you perceive as to be a low insurance rate. Whenever a storm comes in and you've got to pay $5,000, $10,000 out of your pocket, it's not so fun at that point. So again, check your deductibles, check and see what type of deductibles they are. Now with replacement cost, home values are going up. All of us have probably received our tax statement from the tax assessment department that has said, hey, your value is now worth X. Insurance companies do the same thing with your homeowner's insurance. They run a replacement cost estimator on your home that if your home was damaged by fire, destroyed, whatever, it would cost this much to rebuild it. That replacement cost is not what the tax records say, not what your taxable amount is, and it is not what you can sell your house for. It's important to understand that that replacement cost is what it would take if they have to clean the slab off, start back over, and totally replace your home. Sometimes that gets out of whack, meaning that they automatically raise your home value 3 to 5% every year. Sometimes it gets undervalued, meaning that the cost to replace your home is more than what the insurance company says. You want to check that. I did mention roof coverage. You want to, again, look at actual cash value versus replacement. And as always, shop around, but be on the lookout if you're going to lose benefits. I encourage you to bundle because there's sometimes bundling discounts as well. So there are some ways that if you shop around, you can save several $100s that can go a long way these days. All right, let's talk about life and health insurance. First, let's talk about life insurance. If you were with us a few weeks ago, we talked about life insurance and how it impacts state employees, what your state plan is, as well as what your state retiree plan is, and how it goes down the older that you get. You've got to really look at who depends on you, especially if you're a single mother and you've got young dependents. I highly encourage you to get more insurance than you have available through the state. Okay. Know your state plan. Know that you can get up to 4 times the amount of your income up to a certain max with your state plan. But I would encourage you to have something outside of that. As you get older, you may not be financially responsible for anybody else. You don't have to worry about that. The one thing you want to think about, though, is what happens if my spouse passes away and I am dependent upon their pension, or I'm dependent upon any type of income that they receive. Some of those pension benefits may go away depending upon how your spouse chose to select those pension benefits. You can use life insurance as a replacement for that pension benefit there. I like to say you need to decide whether you want to own versus rent your insurance coverage on life insurance. As a state employee, if you're taking out life insurance through the state, you're renting your insurance because that insurance is dependent upon your employment or your activation of your retirement benefits from the state. If you own your insurance, meaning you have a policy outside of work, then you have control over where you use that. Depending upon your age, term insurance versus permanent insurance, there's a decision you need to make there. With term insurance, it's much less expensive. You can get a lot more coverage. My wife and I took out a term insurance plan for a larger amount that would cover her or myself while my kids were growing up in school and in college. That if something happened to us, we'd be able to make sure the kids got through college. Once they get out of college, we may not need as much life insurance, so we can scale that back. Or a permanent plan allows you to know that you've got level benefit, level amount of coverage, and a level price all the way through into your final years there. You can use these life insurance to pay off debt, student loan debt, home, things like that, but always make sure who your beneficiaries are. Ray talked about open enrollment period. If you do nothing during open enrollment period, but check who your beneficiaries are for pension and life insurance, you will do so much better for yourself. Deanna and I have seen too many times, too many individuals who have had either an ex-spouse as their beneficiary on their life insurance and the current spouse didn't know about it, or they've maybe had 2 kids covered and not that third child in terms of a beneficiary. Check your beneficiaries now. And then as Ray mentioned with open enrollment, now's the time to understand your health plan. The good news, thanks to the state, thanks to what TPEA has done on your behalf, your ERS plans look like they're all going to stay the same in terms of premiums, deductibles, things like that. Know your plans, know where your gaps are, for lack of a better term. Know what happens to your rate if you or your spouse pass away, because depending upon who carries that benefit, the cost can go up dramatically. So know what that looks like, and they will have tables in there. It'll be on the ERS website. It will show you what the surviving spouse rate is, because it could go up quite a bit, and you would maybe need to have some other plans, whether it be life insurance to cover that or what. Know where your biggest gaps are too, especially when it comes to care after a cancer diagnosis or care and recovery after a stroke or a heart attack, because there are some pretty good sized gaps, whether you are on the state plan, a private plan, or a combination with Medicare and the healthcare advantage, things like that. So know where your gaps are. So those are some steps that you can take to save you money, to become more educated in terms of your overall health and wellness plan. So let's talk about this from a savings and retirement standpoint. As we showed you earlier, women live longer than men. So you've got to prepare for, on average, 10 to 15 years longer than your spouse in retirement. That means that you need to start early. You need to start thinking about what the impact of inflation is going to be. Take advantage of your state plan. It is such a good plan. It is such a low cost plan. I'm going to show you the impact of costs on that as well. Most experts will say that you probably need somewhere around 80% of your pre-retirement income in your retirement years. The good news is, because of the way your state benefits are structured, you've got some things you don't have to worry about going forward unless you pass away and you're carrying the health benefits and your spouse is responsible for that. So as good of a health plan as you have at the state, as good of a Texas Saber plan that you have from retirement planning, I encourage you to have some outside savings as well. It does a couple of things. It makes sure that you diversify your portfolio, your savings portfolio. It may give you some more flexibility in terms of taxation situations. And if you ever do leave the state for whatever reason, you've got something that you already have outside that you can either move your state money to, or you can start up an IRA and start funding it that way. Make sure you understand the fees that are out there, and make sure that you understand the tax advantage, or take advantage of those tax credits. I'm going to show you that in just a moment. This little graph shows you kind of what the difference is if you have, if you start early. You see this graph over here, it shows if you start at age 25 and put in just a small amount, it's going to grow significantly whether you wait till age 35 or 45 or 55. So I encourage you to start early and participate in your plan to take advantage of what the state offers to you. I'm going to take a couple of slides here and show you, and we've had some of this from Jennifer over at our friends with the Texas Saver program. And you have 3 sources as a means of savings in your retirement. And that 3-legged stool, you've got your ERS pension plan, which is a phenomenal pension plan. Again, TPEA is working on cost of living increases, so you need to understand how that works within the ERS retirement plan. You also have Social Security, which is a stable plan that does have some cost of living increases built into that. The only challenge we see with that is every time that they provide a cost of living increase in Social Security, They also raise Medicare rates and other rates as well. So not always is it great, but that does have a built-in cost of living increase factor in that. Then you have your other accounts, your 401k, your 457, or any type of personal savings accounts out there. And that's where ERS comes in with the Texas Saver plan that they offer to you. Because as you're working through your career, you've got your income, and hopefully it's going up. We all hope that. Whenever you retire, you've got your pension down there at the bottom. You've got your ERS pension coming in there. And there may be a gap before you start to draw your Social Security benefits. And so that retirement income gap, that's what you need to save to either bridge until you get to Social Security or to cover some of those cost of living inflation opportunities that are going to eat up some of your income. And that's where Texas Saver can help you do that. Outside planning through IRAs, Roth IRAs, things of that nature can help you do that. Just a quick hit on the Texas Saver plan. You have a wide variety of options. You've got pre-tax that will take it out prior to any taxation out there in a traditional plan. And you've got some after-tax Roth options that are phenomenal, in my opinion, because it's money that's already been taxed, and all the growth and everything that you grow out of that is not taxed. And there's a lot more flexibility with it. You can use it for college savings. There's a lot of different things that you can do that. It is automatic. You can sign up anytime, get it payroll deducted, put it out of sight, out of mind. You have eligibility for the Savers tax credit. I'm going to share with you that in a moment. And for many people on this call, this is a huge opportunity where the government is rewarding you or incentivizing you to save, because they know that this retirement gap is coming. They don't want you to have to worry about it as much. They're going to incent you and save you a direct credit off your taxes for saving. There's a lot of ways that you can access this. It's real easy to find off the ERS website. If you worked at a private company, you can also roll this money over as well. So again, the Texas Saver plan puts you in control of your retirement. And as we mentioned, ladies, you've got many more years to prepare for. And so I encourage you to take advantage of this right away. This just shows you again, if you compound your savings every year at an extra percent, it just means a little bit more in retirement for somebody making maybe $40,000 a year. It really is not big salary. You can almost supplement and equal out your pension plan. So you can imagine getting a Social Security, a pension plan, and then a duplicate pension plan because of your Texas Saver money. So again, it allows you to make a difference that way. And then let's talk about that Savers credit. And this is something that you can do, your spouse can do. Some of it's based on combined household income, but it allows certain individuals, 18 years or older, who aren't full-time students and can't be claimed on anybody else's tax records, with a certain income, to have a tax credit. And this is not a tax deduction. This is a true credit. So it's really a neat situation that you've got out there where you can save up to 50% of your retirement plan contributions. Up to a certain amount can be directly credited to your tax, to the tax amount that you owe. So that's basically the government saying, we're going to tax you less if you'll save the money. And here's the current table that you've got for this year. You can see, depending upon what your filing status is, what your income is, what your adjusted gross income, and this is adjusted gross income. So think about this. This is after taxes have been taken out, after any healthcare expenses have been taken out, after all those things have been adjusted. So you could have a higher salary, but once you adjust your gross income down, you still may be eligible to take some of your income off and receive a tax credit of what you contribute. So again, take advantage of the Savers credit because it can save you $1,000 off your taxes that you put towards your retirement. You do that several years in a row, it becomes more income for you in retirement. And ladies, we've got to keep that income up as you go forward. Now let's talk about the fourth issue, is once you've saved that money, once you've saved money in Texas Saver, saved it in an outside IRA or a Roth or something like that, you've got to protect that nest egg. The good news is Social Security's there. The good news is your ERS pension is going to be there. But what about that money that you've saved up in addition? What about that nest egg? You've got two big threats as women. One, taking care of your elderly parents. most studies will show, and I'll show you some numbers in a moment, that the daughters in the household are going to take care of their parents. And that could mean that you've got to take off of work and cut your career short and cut your pension short and all that, or you've got to find some means to care for your parent. The other big threat to your nest egg is overexposure to the stock market as you age. And we're going to talk about those in just a second here. This goes back to taking care of elderly parents. And the fact is that 73% of all long-term care is done in the household by an unpaid informal caregiver. And what that means is usually it's the daughter that has to stop her career and take care of mom or dad. And that does a couple of things to you. One, it stops your earning power right now. So you're out just salary income right away. And two, it stunts those years that are contributing towards your full ERS pension. So again, having a plan that makes sure you take care of your elderly parents can make sure that you have a full retirement, make sure that you're able to provide for your children's college and take care of your family as well. So you see a significant amount of money for females. Unfortunately, it weighs on females more than men in that regards. Overexposure to the stock market is another one. We look at that right now. I open up my phone every day. I see the red, I close it. I don't like that. Those of us who were around back in 2008, 2009, saw a 50% drop in the stock market. We're down now 30% or so in the past several months. You've got to think, can I afford to take a huge hit in my retirement savings during my retirement years when I don't have time to make it back up? If my nest egg is dropping while inflation is going up, how do I protect that money so that I don't run out of money or so that I don't have to lose significant amounts of money? Most people aren't afraid of passing away. They're afraid of outliving their money. And again, as we showed, women will outlive men by 15 years. You've got a lot of years to plan for that. There are some tax deferred plans that TPEA endorses, that AMBA offers, that allow you to have a lifetime steady income, that allow you to participate in gains in the stock market, but no losses in the stock market. But the thing that I like most about this plan is it has some long-term care benefits. And this is why I did it for myself. My father spent the last 2 years of his life in a nursing home with dementia. Because there's a history of family dementia in my household, it makes it difficult for me to qualify for long-term care at an affordable rate if I can qualify at all. This particular plan allows me to set aside money. And if I don't need it, that's great. I enjoy my gains. I have a separate third leg of my stool because I don't have a pension that I can use. But if I need it for my long-term care, for my wife's long-term care, I can tap into it with no penalty. Or if I'm already drawing out money and I have to be confined to a nursing home, it doubles my payout. You can't call ERS and say, hey, I've got to have long-term care. Will you double my payout? So it allows me to do that as well. So that's a way that you can protect your nest egg, not have to worry about outliving it, but not have to worry about losing money just when you need it the most out there. And then finally, I want to wrap this up, especially for women. Thank you for joining us today. Please, please, please have your estate planning done. And we think to ourselves, oh, I'm not rich. I don't have a palatial estate. I don't have a ski chalet up in Colorado and a yacht down in the Caribbean. Estate planning is for everyone. We did this for my mother several years ago, single working mother, because we wanted to make sure that her wishes were carried out. It was about $300 to get a will, a financial power of attorney that let us know, in the case of my mom's incapacitation, my brother or myself could handle the finances. An advanced care directive, if she was mentally incapacitated or physically incapacitated, what were we going to do for her care? All of those documents are so crucial to have. They're not expensive at all. Please, please, please get that taken care of. Get those documents together, have them there. Make sure your beneficiaries are up to date and they're current, because this final step, after you've worked hard all your career and taking care of your budget, your credit, saving money, taking care of your life insurance, long-term care needs, making sure your retirement's there, having somebody determine mom didn't have a plan to do with it, what are we going to do? Make sure those things are in your control as well. So if you've got questions, drop those in the chat. We want to hear about it there. I'll show you a QR code here in a moment where you can get more information. We're going to come back and have a conversation here next Friday, a real quick turnaround time on the basics of long-term care. We're going to talk about why most state plans aren't even offered anymore, why it's not available through the state, what TPEA has done to step up to fill that gap, but really just kind of expose you to the issues that are out there, the current cost, how COVID has impacted long-term care, and help you understand what may or may not be a challenge out there for you and your parents. So look on the calendar out there, look on the emails that are coming out for the basics of long-term care next Friday. All right, tell your friends about these webinars. Tell your coworkers about these webinars because we're stronger together. We want to make sure that we get a good group of people that know who TPEA is, become members, and then Ray and Ann and those who testify up there. So we've got tens of thousands of members behind us that are supporting the issues that are on your minds. And this is a great way to do that. So open it up for questions. If you've got questions, feel free to open up your camera on your smartphone, hover over that QR code. We can answer product related and plan related questions that way. You can email me at john.green@amba.info if you're on your smartphone or on your tablet. And we've had a few questions come into chat. And while I check those out, is there anything that you want to add in your years of experience at ERS that ladies need to pay more attention to because of what you saw?
Well, absolutely. It's not anything different than what you've said earlier, but get your plan and your documents in order. Once somebody becomes ill or somebody passes away, whether it's you or your loved one, it's too late then to do a lot of things that we're talking about today. For instance, I can't tell you how many people didn't have a power of attorney just to be able to make health care decisions or be able to sign checks to pay bills. And once somebody becomes incapacitated or ill, they may not have the legal ability to give you the authority or for you to give somebody else the authority to manage your money, to manage your estate, to take care of you. And there's nothing a judge can do. There's nothing anybody else can do at that time other than to go to court to become a guardian of the person. And that's expensive. It also is very emotionally taxing to become the guardian of somebody if they haven't decided, or if you haven't decided that is what you want. So think ahead. I know that it's sometimes uncomfortable, but please think ahead and get that in order so somebody else doesn't have to make these decisions. Or if you're the person making the decisions, that you are comfortable making these decisions on behalf of somebody else.
Exactly. Thank you, Ann. Now, Deanne, I want you to answer this question. Kate has asked, and this is a good one for the group, that TPEA endorsed deferred asset protection plan. Is that available just to active employees, or is that something that retirees can take advantage of as well?
That is definitely something that anyone can take advantage of. So I did answer that question. I think I didn't do it to everyone. I just did it to Katie by accident. But yes, you can contact John at this email, fill out that information, or you can open up your camera and do the QR code. And one of us will give you a call and we can discuss it with you.
Great, because there are some age requirements or things like that in there, but we'll take care on that. Perry asked, how do I find out more about the tax credit? I will encourage you, Perry, go out and look at Saber's credit on the do a Google search. It's a really good. There's several different resources out there. I would specifically, if you've got someone who does your taxes, ask them about that. I know I do mine through just the H&R Block, put in the disk, that kind of thing, and it'll there's some questions, but it's not real specific in there. But I would highly encourage you first do your research on Google. It's a government program. It's real simple. I pulled that table directly from the government website on Saber's credit. Encourage you to go out there to take a look at that. And then, Ann, here's another question that's come through that I want you to answer. Does Texas require that the person receiving the power of attorney, whether it's general or medical, or becoming the guardian, that person lives in Texas?
No, I do not believe that's the case. And of course, we can't officially give you legal advice, but I do know that my sister-in-law's power of attorney is her daughter who lives in Canada. Now, a practical matter is that she's in Canada and the daughter's in Canada and my sister-in-law lives here. So any kind of healthcare decisions or anything like that takes a little bit more time than if there is a local representative or somebody that is able to respond quicker.
Okay, thank you. We did have a question about accessing the QR code. If you're on a laptop or a desktop, the best way to do it is to take your smartphone and open up your camera feature, hover over that QR code, a little form will pop up. Simply hit your finger there. You can ask review my benefits, long-term care, tax deferred planning, that kind of stuff. And it will come back to me right away. Deanna and her team will get a hold of you pretty quickly. If you're on a smartphone or on your tablet, there's no really way to access it. So that's why we give you my email address, john.green@amba.info. So we'll open up for a few more questions here. I will stop recording.